can't have the ups without the downs.
Well, Fannie Mae's got their own.
Fannie Mae's got their own ups and downs. You know, Matt, I was with brokers and lenders early this week, and one of them said, you know, this is the time period where, you know, the war stories are made, and that we'll be telling the stories, funny. You know, 5, 10, 15, who knows, and the extent of those, and I think they're getting ready to be to unfold, But what kind of a story do the agencies, the GSEs, Fannie Mae and Freddie?
Yeah, we can. I'd definitely like to lump these together because they kind of complement each other. They're talking about roughly the same thing. So Fannie has earned some headlines actually on this month's economic and housing commentary. Not necessarily for their industry-specific comments, but it's their cold take on the economy that's gotten people's attention. Recession, yeah, I think we're going to get it this year, says Fannie Mae. Recession remains likely is the headline of their press release. We have their full outlook posted up here. Their home builders actually are feeling a little more optimistic right now, which is a bright spot in the economy. But that is kind of largely due to the current low inventory driving up demand. And I can't help but think that if builders do start building, then that inventory is going to increase, and we're kind of right back where we started. A recession, on the other hand, that's just not great in any way. Now, I don't think that the recession that they describe isn't like horrible, but it's not great. So they project real GDP growth on a Q4 basis in 2023 to be negative 0.3%, which is up 1/10 from their prior outlook. So a little bit better, but they think that in 2024 GDP is going to be down to 1.2%. The real number that's a little more legible to me was their unemployment numbers, and they project the unemployment rate to move upwards to 4.2% by year end, rising to 5.3 by the end of 2024. Along with the slowing economy, they also forecast inflation to decelerate. But yeah, so if
that's the recession, unemployment at 5%, isn't that like kind of not bad?
It's like the post-night. If you look at the recessions in the unemployment chart, the post-1990s median is about 5%. It's either above it or sloping below it, But I do think that the change of 1 or 2% in unemployment in like a year, that is gonna make people sad.
And the continuing claims I know are starting to pile up. The continuing unemployment claims could be economic signal.
So,
but very, very kind of tepid recession, really more of a slowdown rather than a deep crash is what they're discussing.
So I think so too. And that's a little bit like Fannie Mae doesn't call it a recession, but it's like a slowdown. We are very much on the edge of this. And Fannie Mae explains their forecast of the recession and says that it's largely due to the historical patterns of recessions typically being the end result of monetary policy tightening cycles. Interest rates go up, unemployment goes up. That's like what breaks the back of the economy every time during a recession and starts to bring inflation down. I think that's kind of what they're looking for. And this meaningful rise in the unemployment rate, often coinciding with something breaking in the financial system, has been the way that inflation is contained once it is well above target. But they say that two channels in which interest rate changes affect economic activity, which is new autos and new home construction, these sectors are currently not as rate sensitive as they've been historically. I think that that doesn't mean that interest rates have not had an effect. I think that the economic pressures related to elevated interest rates may not bubble up in this highly visible auto or home loan that everyone noticed.
Well, again,
but it's like businesses hiring, how those are funded, that
investment. Yes. Because there's so much demand. People still want a house. People still want a car. People still want to live someplace. There's still a ton of housing demand, which is baffling some of the economists and experts out there. But businesses are looking at it differently. Again, today, Treasury yields, just 1 month Treasury yields, man, are yielding north of 5%. And so if I'm an investor and I'm going to place capital, the risk-free rate, and Matt, we need to do a video on risk-free rate and risk premium, because people are missing it. Because when someone says to me, I love real estate, we're buyer of real estate all the time, but I'm just going to accept a high price and a return that is so low because it's like, well, I'm going to wait and it's going to work itself out. Maybe that's the case, but if you're an investor, you need to be looking at the premium you're paid for your money. Your money could go anywhere.
Yeah.
And so if there's a place where you can take zero risk and earn 5%, to put your money somewhere else, you need to be earning an excess, a premium of that risk-free rate. So if that risk-free rate is 5%, you need a premium of several percentage points on top of that to even justify it. Now, there's a difference between again, we're talking about income, like current yield, dividends. 5% versus an apartment. Even though it may yield under 5% maybe the first year, the total return, whether an IRR basis, is going to be in excess of 5%. Maybe it's 10, 12, 13, 14, 15, 16. But that doesn't necessarily matter to every investor.
Yeah.
First off. The other factor is that total return projection is a projection in speculative.
Yeah.
And there are more uncertainties in variables today than there typically are in underwriting.
Yeah, and that's like something like, it's like this idea of that book Noise, where if you're investing in your money, you have like one case study, you have one data point, one trend line. But then if you're talking to like an investment manager who's dealing with multiple investments, lots of different opportunities, that person's probably someone that's going through multiple lines of investment, multiple investors. They've probably seen the bad things that happen when risk comes up. That 5% is real, or maybe it's 5% risk is super real to them because they've gotten that 1 in 20 where things didn't go so great.
Yeah.
And so coming back to that beginning article, you can have a great appetite for risk, but if you're not really considering it, or a great appetite for returns, but if you're not considering the risk, then you're really doing yourself a disservice.
It all comes back to, it's like standard deviation. It's not just a plus. Your risk premium, it's not a potential for it to go up, but it's also potential to go down below. So, for every, and again, we don't live in a perfect world or an absolute efficient market. So it's not always like 1-to-1, and where you want to try to find in an investment is like an asymmetric risk, return profile. That's ideal, and where we can often find that in multifamily. But assuming that like we're somewhat close to a efficient market, that the more risk you take, you can go, and one more step of return, but also one step of loss. Yeah. So if it's like, okay, if the base is 10, but we're going to take a standard deviation up 5 points, well, be happy with 15, but also be happy with 5. And that's just not very many investors are thinking like that. Yeah. They just see it's like, well, this one is a 19 and that one's a 15.